And you're just in time for your weekly most comprehensive look at the world of business, finance, and economics. Welcome to another episode of Business Redefined. We want to talk about matters financial markets on the back of the Absa Financial Markets Index, the 2024 edition. As always, what I keep saying, the thing I like about this report is not so much the ranking of the countries, but more importantly, the nuances that we need to tease out, and who better place to do that than Stella Mambo, Head of Global Markets, Director Global Markets, Absa Bank. Welcome on board.
Thank you so much, Julians.
Asante sana.
Thank
Stella,
you.
let's dive right into it. The report, Absa Financial Markets Index, coming at a time when we have seen a bit of, should I say, much more moderate activity in the global markets compared to where we were last year. What are some of your key takeaways from the report?
So thanks, Julians. I think we're very excited as Absa Bank. This is our 8th edition. And the importance of this launch is to try and help the market understand how the market has developed over the couple of years. There are a couple of indicators we look at. And this year we're very happy because we were able to get an additional country on board. Last year we were about 28 countries. This year is 29. We've onboarded Benin. You know that Benin went to the market for funding, Eurobond, and was quite successful. And we thought it would be important for them also to be part of this participation. I think for me, the key takeaway, and specifically for Kenya, I think there are a couple of positives that we've seen, especially around market depth in terms of what has developed there. I think for me, the biggest takeaway is around product diversity, which we still continue being a very important pillar, and one where, as a country, we're doing quite well. We've seen a lot of products coming into the market. I think the latest new kid on the block is the Sukuk bond that was issued in May. Yeah, and that bond was actually just to go to the market to get affordable housing funding, which again speaks to the ESG program and the sustainability angle that does. I think the other positives around the macro. To be honest, we've seen a bit of positive in that area, as much as we still have issues around debt and serviceability of debt. We've seen positives around inflation. Inflation has been coming down, and there's also just pointed onto that report. I think the other one on that particular space is around how the GDP for the country has been still resilient despite some of the global shocks we've seen. If you think about it, the Russia-Ukraine, the impact it has on the commodity prices. We've seen a lot of escalations in terms of just the whole environment in terms of asset class reallocation, especially on the backdrop of foreign exchange and all that impact it had. And that, just seeing that sustainable growth is a positive. I think obviously there are areas of improvement, as we always say, with any other report. There are things that we can work together to ensure that the market develops and deepens further. I think one that's quite key to us, especially on the financial market world, is the legal standard and how we utilize closing netting for derivative structures, being able to also be recognized by international bodies like ISDA, International Capital Market Organization, will be very important as we try and deepen our market from a funding or a yield enhancement structure. So I think that's quite important. I think that's an area where we're going to work together. We've seen improvement again on the access to foreign exchange.
Correct.
I think the reserves have done quite well.
Yeah.
As you've seen, now we are roughly at about 4.8 import months cover, which is way above where the regulatory limit is. So very positive. I think the central bank has done a fantastic job in ensuring that accessibility, and also just creating that FX reform that we've seen in the market that has enabled that investor world to be able to come in and exit the market. I think that has been quite a positive.
All right. When you talk about product diversification as one of the sweet spots in the report, market players always argue that whereas we are quite strong in terms of product diversification, we seem to have a lot of weakness when it comes to uptake by retail investors in particular. And that's one of the things which the report mentions, that we need to do more activity around catalyzing uptake by retail players. What are your thoughts on this, and what is Absa in particular doing around this?
Yeah, good point. So as we said, products are there. I think the bigger elephant in the room is around uptake, as you've rightfully said. I think there are a couple of things that come to my mind. Education is one, and how do we go to the retail investor just to help them understand what the value of an investment asset class is all about. I think the traditional Kenyan way or the traditional African way is to buy what they call land or buildings. I think that's going away, and people are starting to look at what other sort of more liquid, almost near cash investment solutions are there in the market. And I think that's pivotal because you've seen if you have cash, you're actually king. So in terms of that retail framework, a couple of things are happening. One, some of them we're working with other like-minded partners. Others we're working with the regulator. I think first I want to mention what the regulator has done. The central bank, fantastic in terms of creating that CSD platform, allowing retail investors, you and I, are able then to go in and be able to participate in the fixed income market more in an efficient way, very transparent way, and that helps in terms of that deepening of the market. I think outside of that, there are a couple of things that needs to involve, I think for me and quite passionate about, is how do we tokenize that asset class? Because the big challenge is the retail investors may not have a pool of funds if you compare to a bank or a DFI or an institutional clients. Then how do you accommodate them? And it's just breaking down that chunk of that asset class into small units that can then be offloaded. And I think that's the big item that needs to happen, what we call tokenization of assets. And I think we've started seeing that going through. We are aware of one telecom working with a very known asset manager or a stockbroker, trying to put something together to be able to then offload equity or stocks in smaller tickets. That today, as we speak, someone who is selling boga in Marigiti town can be able actually to buy units of equities or a bond or anything in smaller units. I think would be a fantastic plus. I think that's going to be critical and an area where we're going to try and do that. Digitization obviously becomes topical because then it brings you almost that arm to be able to take control of that. And a lot of those elements will be more around how do you get those assets into a digital platform. And I think that's going to be a lot of play that both the bank as well as the regulator have to work together to ensure that good transitioning happens.
I see. The report speaks a lot about pension funds and the role they play in catalyzing market activity. And whereas we have what we would call by SSA standards robust pension funds, assets under management just shy of about 2 trillion bob, the concentration on fixed income is the conversation we keep having every year. And if you speak to trustees on the pension side, they will tell you it's a no-brainer. If an infrastructure bond, tax-free, is giving me 17%, why should I be bothering going into the risk-laden equities? How do we begin to recast that narrative around the pension side?
That's a very good question, and a question where even us as banking institutions have struggled with, and one where we're starting to see how do we penetrate into that market. You're rightly said. I think the pension asset under management, almost 70-80% is concentrated on fixed income. Partly sometimes you see pockets of equity coming through. But then I guess the question is, are there products, are there alternative asset class? And I can be very positive here because to say as Absa Bank, we've been very intentional around growing that space. And how we look at it is we've asked ourselves, what does this asset under management really require? What are they looking for? They are basically looking for yield. They're chasing the yield. They're looking for an enhancement in terms of their return. And some of the items we've been able to come up with is to be able to wrap solutions that have insurance element that enhance that rate. And some of the things we've been able to do are credit-linked deposits or credit-linked notes. On the backdrop of that is that even if you don't have a Euroclear account, you can come to us. We can give you exposure to one of the South SSA reference currency or bond. You're able to get into that market. On the back end of that, we buy what we call an insurance of the underlying. Typically in the financial world, it's called credit default swap. We wrap those together and then we give it back to you as a credit-linked deposit or a credit-linked notes. Essentially what we've seen, those type of solutions are actually beating where the yield curve is. You find in a normal typical period, you could see another 100 to 200 basis points uplift from your traditional yield. And that then will be sort of an idea where a fund manager will say, I want to jump into this. I think that looks very creative. And I think the beauty about that is it also allows you to get exposures to markets where A, maybe you don't have presence, or B, where you don't need to go and reopen operational accounts. And that's where we come in, almost as an intermediary between yourself and looking at for other markets that we've seen. We've seen that to be very fantastic. The other solutions around commodity-wrapped solutions, ETFs is another area where we think pension funds should be able to look at. We have a gold ETF listed on the Nairobi Stock Exchange. You've seen what has happened to the gold prices this year. I think that's the best performing asset class this particular year, even when you strip out fixed income in terms of growth. And the question is, why are fund managers, why are investors not looking into the asset class as something to come in? And I think that's where we come in to try and say, this is how the parameters of the return are, and this is where the risk is.
Okay. One of the emerging conversations around the financial markets is ESG consideration. And as a matter of fact, just about a couple of days ago, the roadmap for adoption, mandatory adoption of disclosures around IFRS S1 and S2 was rolled out in Kenya. How do you see that changing financial markets in terms of, one, asset classes, and secondly, in terms of demand from investors?
So that's an interesting question. Obviously, I'm not an expert in terms of the accounting area, but what we're trying to see is right now is that ESG is now being incorporated into the financial sector. You rightfully said, we actually mandated now by the central bank on a regular basis to sort of, do reports around our sustainability from a lending perspective. And what you're starting to see is that a lot of solutions are coming up in terms of the ESG. I think one that's already in the public domain, you're aware Safaricom went to the market to raise a sustainability note program to be able to fund some of their projects they're doing. And that ticket was roughly quite big, about billions of shillings, where a couple of banks, including ourselves, participated. And that was a good element. I think what we need to look at is around the climate risk side is, if you think about it, and you've had a chance to look at the World Economic Report, it says the three big risks we're seeing around the climate is, one, obviously the effects of the earth, and that's coming either because of overheating or overfishing, pollution of the environment, and that's changing the dynamics there. I think the other effect we're seeing is weather patterns. We've come from a period of heavy rains. We had, and now potentially, if you listen to the weatherman, there's potentially La Nina expected into next year, which obviously has an impact. And then lastly, is obviously things to do with biodiversity, species or animals just getting distinct from the earth or from the environment. And I think those are the areas we need to watch. So in terms of how do we see that unfolding, we see it an element of whereby the banking sector will have to coin either solutions to be able to cater for those risks as they emerge. And I think that's one of the areas we're going to work towards.
Stella, many market watchers who aggressively read the Africa Financial Markets Index report look at it more from a risk management and risk mapping standpoint. And I'm always curious around when you talk about this climate ESG related consideration, where climate has outsized risks whose outcomes more often than not are undefined. How do you begin to price in that risk? When you sit down as the head of global markets here, how do you really calibrate that?
It's a tough one, to be honest, Julians, in the sense that because of the key risk factors I mentioned earlier, it's almost a gray area in terms of what to price in. I guess the best way to look at it is what impact does those climate risks come in terms into the financial markets. And I think they have an impact either around interest rates, around FX, around how the environment involves. And one of the things we've done as an institution is to try and help clients first understand how those macro environmental pricing in terms of the output of their businesses, and try and see how do we help them mitigate against those risks. So one of the things that we do more often than not is to try and help clients come up with a risk management policy that just crosses down in terms of what are your inputs, what are your outputs, and what are the risks ring-fenced there, and what are those emerging things that you need to start doing in terms of hedging those risks. So if you think about it, in terms of the asset class, I think the most sought one is obviously FX rates and commodities in that space. And what we've done over time is then to help clients put what we call a hedging framework around are you a passive, are you active, or are you reactive in terms of how your policy is. And that's important because then in terms of how the shaping of those macro come out, enables you to then say this is how you're going to react as a business owner or as an investor, and that's quite critical. And we have an array of things that we can do in that specific area around those asset classes to help you mitigate those risks.
Okay. One of the major developments in the recent past, and I know you're a key fan of this one, is that we saw the bond issuance calendar coming from the National Treasury. For those of us who might not be familiar with this and why it is significant, especially from a financial market standpoint, just help us understand.
Yeah, we're very happy, as you can imagine. This is something we've earned or we've really waited for as investors or as market participants. And, when you think about it, I think there are three things I want to mention why it's important. One, obviously, is to help shape the investor build in terms of their portfolio mix. And what does that mean? Once the calendar is issued, then you're able to, you as an investor or you as an institution, you're able then to say, how do you frame up in terms of how you want to structure your portfolio? You find right now today, if there's no calendar issuance for market participants like ourselves who are institutional, who are banks, becomes very hard to play in the primary market or in the secondary market. If you miss an auction on the primary market, then you're not able to get the same liquidity pool in the secondary market. It either comes at a price, you distort the yield curve, or you're normally not able to get the full ticket. So these calendar issuances will help an investor plan themselves better in terms of their portfolio mix, how they want to structure their book, what's going to be on the short end, what's going to be on the long end, how you're going to play around exiting or what we call churning of that book is going to be critical. I think that's one and very positive for the financial market world. But I think the other one is around, and this also speaks to the national treasury or the government in all, it brings in the monetary policy signaling in terms of once we see the calendar, you're able to sell, is the direction of the rates either going to go higher or lower, depending on where that calendar is speaking about. So if you find most of the bonds or bills are concentrated on the short end of the curve, it just tells you that there's a likelihood rates might slightly go higher. And that's why right now concentration is more on the short end of the curve. And then the last one is obviously debt management signaling. So just basically saying, why are we issuing this calendar for this particular period? Is it because you're trying to manage maybe the short end, the long end? Are we trying to lengthen the tenor of the maturities of the profile? And we've seen central bank doing a lot of that, doing what we call switches into the markets. You have a treasury bill that's coming to maturity, that's been converted into a bond, potentially a 2-year, 3-year out, and that just helps them in terms of managing their debt redemptions that come forth. And I think that's really good in terms of also the country as a whole and trying to manage our debt pool. I think that would be very important, and we're very excited as a market participant.
And we certainly hope we stick to it as guidance given. One of the key pillars of the report is around the regulatory environment. And many investors who look into this market will tell you they feel there's a bit of what they call regulatory overreach, especially from a taxation standpoint. Give us some color around what the report says around the regulatory environment and how you see it going forward.
So the way the report looks at it from a regulatory perspective is more around what are the policies or what are the frameworks that have been put in place to enable the capital markets to thrive. And if you think about it, Pillar 3, which is basically market transparency, market environment and transparency, essentially just tries to map through what are the elements we're seeing on that. Obviously, tax becomes a key factor, mostly to do with fiscal consolidation. And I believe that's not just in isolation for Kenya. We've seen a lot of countries doing that in terms of enabling taxes to be able to meet their budgetary needs. And what we've seen is that the government has tried to use mostly both indirect and direct taxes to be able to capture that. There's obviously some effect, especially some which are tied into the financial markets. As you're aware, there's going to be a 5% tax on the infrastructure bonds. And with the market participants, as what are we asking or what are we saying about it? I think for us, we don't see a big impact, to be honest. And why do I say so? I say so because if I compare the other regions within or the neighboring countries, I don't think there's any country within us that has a fully tax-free bond. And I think for the longest we've enjoyed infrastructure bonds being tax-free. Obviously, they are darling to both the local investors as well as the foreign investors. But I think the return and the massive around it portfolio inflows is still going to be there. We feel the tax element is still much lower if I compare it to the traditional bonds. If you look at where the FXDs are less than 10 years, there's a tax element of potentially 15%, and anything else above that then is 10%. So I think it's not unique in that factor. I think we just have to ask ourselves, what are these frameworks the government will put into place to help drive that? I think that's one. And then the other one is obviously how working together with the likes of, specifically for Kenya, Capital Market Authority, as well as the Nairobi Stock Exchange, to try and deepen that outreach in terms of the investments and what we are seeing. And we're very fortunate to have a very good Nairobi Stock Exchange, which is very driven in terms of asset classes. We've seen a lot of drive in terms of creating either platforms or either allowing other participants to come in to create our liquidity. We've seen the policies that are being written down by the capital market, again, just to try and incentivize some of these financial solutions into the market. So it's basically what we're seeing right now.
Just to piggyback on your point around the proposed, and I have to clarify, it's a proposed imposition of withholding tax on infrastructure bonds. I struggle with two things. One is why the government would raise its own funding costs. And if I'm an investor playing in the IFB space, I'm sophisticated enough to price in that in the yield. Don't you think on a net it doesn't really hold much compelling?
You're right. So potentially there could be a premium on the yield. But I think let's take it and strip it out to the traditional bonds that we have, the other FXD bonds, and in terms of what tax element. To be honest, I don't see it as a big impact. A 5% is no here nor there, because of the mere fact that those bonds are quite still very attractive, and in terms of even with the addition of that 5%, I think there's still going to be a lot of investor appetite, mostly on the offshore as well, and I think that's something we'll continue driving. All
right, so Stella, one of the developments we've seen in the recent past is major central banks, whether it's the US Fed or the Bank of England, beginning to cutting their rates. And many investors, market watchers looking at this side of the world are wondering, what does this mean for the investment landscape going forward?
Yeah, so it's going to be an interesting path. I think the signaling we have right now is that we started seeing Fed specifically starting to cut rates, easing their monetary policy. What you typically find that is when that happens in the developed markets, there's sort of what we call an asset allocation, and the frontier markets like Kenya, benefit or the developing countries, and essentially what those investors are looking for in the financial market is what we call a carry trade. Is basically playing or taking advantage of the interest rate differential of two currencies. So you'll find when rates are coming off in the US, you'll find money starts to move from the US to the developing countries of the frontier markets like Kenya, and they start coming in as portfolio inflows either to the equity as well as the fixed income. I think that play is something we'll continue. There are a couple of factors we'll look at. Fed is very data-driven. They are not. They actually look at the data. They look at the inflation numbers. They look at how the unemployment rate numbers are looking at, and then they make a call in terms of how that will process. I think the risk we're starting to see is that major industrial economies, especially the US and the China, potentially, or Europe, those could potentially start having disinflation, whereby we've started seeing reduction of rates of inflation coming down, but there's a risk there because of elements of that manufacturing sector as they focus more, moving from the agriculture to manufacturing. I think that could have an impact. And that, not to say is that if that has an impact on those developed markets, what impact does it have for frontier markets like Kenya? I think there's no direct correlation in terms of the FX risks. The only movement we see is that asset allocation. But it has a positive impact in terms of as much as the portfolio flows come in, we sort of see stability in terms of the currency, and that gives a bit of dollar inflows coming into the country. I think it's important to any businesses or in the country to just maybe have a sense of where that direction is going to be. I don't foresee an area where it's either going to be easing all throughout or tightening all throughout from a monetary policy. I think we see it as a bumpy road, depending on how inflation, employment levels look like in terms of how the general economy shapes out. I think it's an area we're going to have to look at. But the positiveness is that are there mitigants against that? Yes, there's a lot of solutions in the market to try and capture those FX risk or those interest rate risk. We've been very fortunate as an institution to be able to craft solutions in both those areas. We do have things that can help mitigate that risk, be it if you're looking at it from a risk profile perspective and you want to go in and potentially even buy optionality. And those solutions are actually there in the market that can help you mitigate that downside risk if there is coming through.
Final question, Stella, I'm told we're out of time, is that for a long time, one of Kenya's bright spots in this index has been the fact that we have a green debt instrument listed at the Nairobi Securities Exchange. That instrument is now delisting, of course, following redemption by the parent company, which is Akon Holdings. And we don't seem to have a pipeline, at least to the best of my knowledge. Does that begin to dent Kenya's profile?
Not necessarily. I think there are pockets of other solutions that are being sought out. If I think about it, I think one that's coming up, obviously not in the public domain, but I can speak to what it all entails about the solutions on debt nature swap, around how do you utilize some of the foreign debt we have as a country to be able to replace that with some environmental funding solutions. So I think that's going to be a big plus. The other area that we are starting to see is that as much as you rightly say the green bond is coming off, the corporate bond market is an area where we've struggled as a country. We haven't had many issuances in a long time. That market is starting to pick again. Potentially we'll start seeing this particular year, we've seen a couple of corporations coming to us, asking us to help them list some bonds. Those discussions are on the pipeline and you start seeing them unfolding into next year. And overall, I think because the market is looking for ESG-driven solutions, I think those will still come through. So I'm not worried about the Akon delisting. I think that was a good starting point and a positive. Post that, as I said earlier during our discussion, World Bank again is working very closely with National Treasury to put a sustainability bond-linked bond, similar to what we've seen to countries like Botswana and sort of Zambia. So I think we're moving into the right direction. It's going to be an array of time, but then we'll be able to come through it.
Stella Mambo, thank you for your time. We have been having a conversation with Stella Mambo from Absa Bank, where she's the director in charge of global markets, touching on a range of issues from FX to domestic developments and what major players like the US Fed and Bank of England and their actions mean for the investment landscape here. Keep it business refined for all the latest updates on how this pans out and what it means for your portfolio. Stay tuned.